Hello, and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's guests are the ADMIS Research Team of Mark Bowman and Mark Soderberg. Starting with the grains, Mark Soderberg, what are your expectations for tomorrow's USDA report?
Good morning, Jeannie. Well, markets seem to be concerned. We could see an upward revision to last year's crops, particularly on the corn side. My stocks forecast of corn at 1.344 billion bushels. That's up 19 million bushels from the USDA estimate in the September WASDE report. And that's also just slightly above the average estimate from both the Reuters and Bloomberg surveys. If there's any changes to last year's crops, I think it will be minimal. I suspect exports for the 24-25 marketing year are going to move up a little bit, however, being more than offset by a lower feed usage. In beans, I've got September 1 stocks at 320 million bushels. That's down 10 million from the USDA in September. Very much in line, my estimates very much in line with the average trade guesses. I look for higher crush numbers to draw down stocks there a little bit. In wheat, I've got all wheat production at 1.905 billion bushels. That would be down 22 million bushels from the USDA estimate in August, and that is at the very low end of expectations. I've got winter wheat production at 1.342 billion. That's down 13 million bushels, and spring wheat at 475 million bushels. That would be down 9 million from the previous estimate. So I've got September 1st stocks at 2.045 billion. That's pretty much in line with the average trade guess, however, well above the 1.992 billion from a year ago. Historically, tomorrow's reports have been a little bit of a bearish tilt for corn and soybeans. In corn, the December contract has closed lower 15 times out of the last 25 years, while closing higher 10 times. And in beans, it's a little bit more pronounced, closing lower 16 times, including the last 4. In wheat, however, it's a little bit of a bullish tilt, closing up 14 times in the last 25 years and 5 of the last 6. The USDA does have a tendency to lower winter wheat production in this report, having done so now 7 out of the last 8 years.
Okay. What other factors will drive prices across the ag space this week?
Well, being the end of the month and the beginning of October, we do have a lot of usage data out this week, outside of just your routine weekly numbers that we see. Begins with the EIA report tomorrow that does update the biofuel capacity and production along with the feedstock usage numbers. This from the month of July, so it is kind of backward looking. We've already got this RIN generation data that would suggest a nice bump up in biodiesel production for the month. Looking forward, however, much uncertainty here with the Trump administration and whether they'll be able to reallocate some of these biofuels that were exempted from the small refineries in August. We also got out the census soybean and grain crush data after the close on Wednesday. Certainly going to see a record amount of soybeans crushed in the month of August. Bean prices, they've been just hovering around just above this $10 level. We still have no soybean sales on the books to China for the 25-26 marketing year. Do not expect that to change unless we can hammer out some sort of a trade agreement. And right now, the market seems pretty skeptical this is going to happen anytime soon. President Trump seems more inclined to want to share some of the tariff income with struggling farmers. However, this may be rather difficult to put together if we see a government shutdown here after Tuesday, if they don't come together with some sort of last-minute agreement. Also, Trump, the Supreme Court, later this month or early part of next month, are going to hear arguments if they agree with the lower appellate court's ruling that the Trump administration didn't even have the authority to place tariffs in the first place. It could be difficult to compensate farmers from that as well. So beans have been stuck in a narrow little range, so it was supported by lower acres and expectations for lower production. However, the demand uncertainties right now continue to weigh on prices, keeping them here near that $10 level.
Thanks, Mark. Moving over to Mark Bowman. What's in store for the sugar market this week?
Well, we are expecting the bi-monthly UNICA report on Center-South Brazilian sugar production any day now. This report will cover the first half of August, and a survey of analysts conducted by S&P Global has an average expectation calling for production around 3.6 million metric tons for the period. That would be 15% higher than the same period last year. And this would also put cumulative production for the 25-26 marketing year, which began in April, at 30.36 million tons, which would be down just 0.2% from this point last year. So after we had a slow start, Brazilian production has recovered quite a bit over the last few months. At mid-June, their cumulative production was down 15% from last year. By mid-July, it was down 9.2%, and by mid-August, it was down 4.7%. So now could be getting right on last year's average. Now, one thing we have to be careful of is, first of all, this number could set the March sugar up for a test of last week's contract low at 1576, but we got to be cautious of the oversold condition, particularly for the funds. The last commitments that traders report showed managed money traders net short 151,000, almost 600 contracts as of September 23rd. That was their largest net short since November 2019, which leaves the market vulnerable to a short covering rally if either the unit number comes in lower than expected, or even if market fails to rally off a bullish number.
All right, Mark, a last question for you. What is the supply situation for crude oil?
Well, in the U.S., crude oil supply is pretty tight. Recent EIA storage reports put crude stocks at 414.8 million barrels. This is up from 413 a year ago, but was below the 4-year average of 418.5 million. We leave 2020 out of the analysis because that supply was 494 million due to COVID, and that would skew the results. Now, stocks have a seasonal tendency to put in a low right around this week, and crude oil production did reach an all-time high of 13.58 million barrels per day in March, currently around 13.5 million, the highest on record still for this time of year. And net imports fell to their lowest level in 6 years for the week ending September 12th, off a surge in imports. The 4-week average, surge in exports. And the 4-week average of exports is currently around 4.1 million barrels per day versus 3.9 million last year and 3.7 million on average. And our net imports then down to 2.2 million versus 2.5 million last year and 2.8 million on average. So we've had decent production, but slowdown in imports due to higher exports. On top of that, refinery runs, they reached a record 96.9% in the last week of July. We've fallen now back to 93%, but still the highest for this point in the season in at least 6 years. Runs have a seasonal tendency to peak in mid-October during the shoulder season. To decline into mid-October during the shoulder season. So we're approaching that. So I describe the situation as not extremely tight, but healthy tight. Refineries are active, and U.S. exports have been climbing.
All right. Thanks to both of you. Remember, the views and opinions expressed here today on this video are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.